Today, I've got your February housing market update.
I keep it real, I keep it real, I keep it real, just keep it real.
Hey, what's up guys? It's Sam Hartman, keeping it real estate right here in Fort Wayne, Indiana. Thank you for joining me, and as always, it is my mission here to help bring some context and clarity to those national real estate news headlines so that you can be a confident consumer in the real estate market. So today we're going to look at local housing data and how the year ended for Allen County in terms of real estate numbers, but we're also going to look at some of those national trends that are affecting and playing a heavy role in the real estate market today. And so here are just 3 quick bullet points about some of the key topics I'm going to cover that are going to be in this report today. First and foremost is that experts are very optimistic about the future. We're going to cover some data that I've covered in the past, but these experts are constantly forecasting and reforecasting, and almost all experts in today's report have been adjusting their forecasts to be much more positive and optimistic for the future of the real estate market. Number 2, home prices rose in 2023 and more of the same is expected in 2024. I'll cover a statistic that says 1 in 4 consumers think that home prices are going to fall this year. This was the same number of consumers, actually it was even a larger number last year, and home prices still rose. So it might not be the right time for you to buy a house this year, but I don't want a misconception of what's happening in the real estate market to hold you back. So we're going to talk about what's happened with home prices and what is going to be looking like in the future for home prices. And number 3, the part that has played a huge role in the real estate market is mortgage rates, and we've got some more positive indicators, but also some cautionary tales as we look at projections with mortgage rates as well. So with that, let's get into it. And again, guys, if you find this information valuable, make sure you like this video, share it with someone else who might be able to benefit from this information, and subscribe so you don't miss any of my future videos in the future. So with that, let's get right into this local data and how Allen County finished out the year of 2023. And so first and foremost, when it comes to new listing inventory for Allen County, we were actually down almost 10%, which means we took 10% less listings this year than the year before. So that tells me I should expect the inventory to shrink because we didn't take as many listings. But here's the next statistic. We actually were down 14% in closed sales. So even though the number of listings shrunk, the number of sales shrunk even more. All right, so that's actually telling me now, okay, we're growing the inventory, which is a good sign because we need more inventory to make more homeowners out there a realistic possibility. Now, here's a statistic that I think is playing a big role in misperceptions of the real estate market, because a lot of people think the real estate market has taken a turn for the worse. And I will argue this, it hasn't taken a turn for the worse, it's taken a turn more towards the normal. And so here's this statistic, it's the percentage of list price to sale price. So if a home seller lists their price for $300,000, how much of a percentage are they actually getting of that price? Well, in 2022, that was actually 100%. So a home listed for $300,000 sold for $300,000. This year in 2023, we actually saw that percentage reduced by 1.4% to 98.6%. And so it's this difference. It's this percentage of list to sale price. It's this longer days on market that are making consumers think, man, the market has really changed and it's really become more and more challenging out there. Now, I will agree with you, the market has changed since the COVID market. But if we look back to those pre-COVID markets, 2017, 18, and 19, those more normalized markets look much more similar to the numbers that we're seeing today as well. But don't you worry, I've got good news here as well, because because even though you might be receiving a little bit less of a percentage of your asking price when you sell your home, here's what you're getting. You're getting 7.8% price appreciation in 2023 alone. This is phenomenal news. This outperforms the national real estate market. For Fort Wayne being a fairly conservative real estate market, this is phenomenal news anytime we outperform the national average. So how do you feel about those local numbers? Are you encouraged for our local community and our local real estate market? Are you discouraged? Are you sad to see that home prices are appreciating? I think overall it's good news. It's good to have a healthy real estate market, but how does that make you feel in your pursuits of your next dream home? All right, let's jump into some of the national narrative as it pertains to real estate and housing. And first and foremost, we're gonna dive into what I finished with our local market, and that is home prices. And you heard me say it in the intro. There is a statistic out there that says that 1 in 4 consumers believe that home prices will depreciate in 2024. Now, this is not a new statistic. This is actually a little bit of an improvement on the previous statistic from 2022 that showed almost 40% of consumers expected home prices to fall. So even in 2023, where we saw the market dynamics that were really challenging for home buyers and for home buyer affordability, we still saw our local home prices appreciate by almost 8%, but still 40% of the consumers thought prices were gonna crash. So did those 40% of people sit on their hands? Did they say, I'm gonna wait to make a decision? Did they say, I'm not gonna buy real estate this year? Well, they just missed out on almost 8% appreciation in 1 year. So now we're sitting at 25% of consumers are sitting on that fence wondering if home prices are going to fall. Are they gonna miss out this year on more price appreciation? So let's start by looking at this graph here. This is the almost 50-year average that shows normal monthly price movement. It shows you how seasonality works in the real estate market. You've probably heard that spring is the best time to list and sell a home. Well, this graph is actually what shows why that is, because you actually see the fastest, highest percentage of appreciation in those spring markets. But here's the thing, there's pros and cons to listing in the winter. There's pros and cons to listing in the spring. So I am not of the right mindset to recommend that you only list a home in the spring if your family's needs are different throughout the rest of the year. The timing might just not make sense to hit that spring market. So with this seasonality, with this graph showing seasonality, it shows normal price appreciation month by month over this 50-year period. And so January, February, March are ramping up low appreciation into more appreciation, where it hits that spring kind of fever pitch of April, May, June, all of those months almost just being shy of 1% appreciation per month. But here's the good news. Let's say you do sell in the latter half of the year where appreciation isn't as strong. You're not losing the appreciation from the months past. You're still taking that appreciation forward with you as well. So that's the strength of this market. That's the strength of kind of this seasonality, is you're not poof and losing that appreciation. You still have it in your back pocket no matter when you sell. But the reason I want to show this seasonality graph is to compare it to this year's seasonality as well. And you can see in January, we actually saw a 0.5% reduction, depreciation in home value. But from there on, we get into a much stronger appreciation period through that spring and summer time frame. And in the second half of the year, we fall into almost identical seasonality of the last 50-year average. And I think that's a great sign. I think that's a really positive sign that we're returning to a more typical and predictable and normalized real estate market, to show consumers that there is some consistency here that you can count on to make a good home buying decision and not have the fear or the risk kind of built into the back of your mind as it pertains to making a housing purchase. And so I'll jump into two quick quotes, one from Brian Luke, head of real and digital assets at S&P. He says, November's year-over-year gain saw the largest growth in U.S. home prices in 2023, with our national composite rising 5.1%. Now remember, year end for Allen County was 7.8%, again showing outperforming that national average. And then a quote from FHFA said that their measurements showed house prices rose 6.6% from November of 22 to November of 23. So there's always going to be a little bit of discrepancy from which entities are reporting the data because of where they're pulling that data from, but overall the pictures are going to be pretty similar. And so I talked about a return to more seasonality, a return to a more typical and predictable real estate market as it pertains to prices. And so I want to jump into this graph here that shows the percentage of annual home appreciation from 1980 to 2023. And I want you to take a good long hard look at this graph. Look at all of the green bars. Look at all of the years compiled on top of each other showing price appreciation. Now look at those red bars. Those red bars have kept more people out of the real estate market over the last 15 years than anything else. Fear is what those red bars represent. The history of real estate is meant to build your wealth, to build your financial stronghold, to build your footing and your financial future. But those red bars, the great financial crisis of 2008, really have struck fear and recency bias into consumers all across the nation. So my advice, my encouragement to you is don't let fear rule the day. Find out the next information, find out the next step, find out what makes sense for you in today's world rather than fearing what happened almost over 15 years ago. Don't let that fear come into your life and affect you making a good decision for you and your future. And this chart here just shows it drives home this point even more. It takes all of those previous years' appreciation. And so over the last 5-year period, the United States on average saw 54% price appreciation. Over the last 10 years, which mind you, the average homeowner lives in their home for 10 years. And that price appreciation, that change in value is 103%. That means you bought a home for $200,000 10 years ago, you sell it for $400,000 today. Talk about opportunity, talk about equity, talk about growing your financial future. And here is the stat of them all. The 30-year ownership shows almost 300% price appreciation. So we can spread that out. You're appreciating pretty much 100% every decade by owning a home. So those 4 years of price depreciation due to the great financial crisis has kept more people from building their wealth and building their future. Don't let that happen to you. All right, so we looked enough at the past. Let's now look to the future of price appreciation and where those prices might go. So for this year, we've got a whole bunch of experts projecting and reprojecting their numbers. And so this is the latest projections from Goldman Sachs, Mortgage Bankers Association, Zillow, Fannie Mae, Freddie Mac, Home Price Expectation Survey, and National Association of Realtors. And you'll notice the only data point here showing that prices might depreciate is Realtor.com. And guess what? Realtor.com is the only entity that has not updated their projections yet from when they were made, which guess when they were made? They were made in the fall of 2023 when interest rates were at 8%. So with that being the picture, that was Realtor.com's expectation, but they have not reprojected at this point yet. So let's look at how all of these expert entities have changed their projections. Goldman Sachs made about a 3% adjustment from 1.9 to 5%. MBA changed theirs from a 1.1% to 4.1%. Zillow 0.2% to 3.5. Fannie 2.8 to 3.2. Freddie not much of a change. Home Price Expectation Survey not much of a change. And the National Association of Realtors more than a 1% change. So the bulk of these entities really made pretty aggressive changes changes to their forecasts and projections of what they expect out of home prices this year. Now, ultimately, this is all going to funnel back down to what happens with mortgage rates and interest rates, and that's exactly what we're going to talk about next. All right, so let's talk about those mortgage and interest rates, because we all know that that is keeping a lot of people out of the market. That's keeping a lot of people from selling their homes because they're not ready to give up those advantageous interest rates that they once had. And so what's happening with mortgage rates? What do we expect out of mortgage rates? Let's jump into that right now. And so first I want to touch on what determines interest rates. What determines your mortgage rate? Well, first and foremost, there's your personal profile. There's your credit score, there's how much income you have, how much debt you have, and all of the things that the banks look at to get you approved for a mortgage. But there's also something completely outside of your control, and that has to do with the Federal Reserve. They are the ones setting the interest rates on the 10-year Treasury yield. And so the 30-year mortgage, your typical 30-year fixed rate housing mortgage, is benchmarked off of that 10-year Treasury yield rate. And so this rate of 4.02, that is the 10-year Treasury yield, but then there is a spread above that. There's a typical spread above that yield where the 30-year fixed rate mortgage will tend to fall. Now, currently, that spread is at 2.9 points. So basically 2.9% above that 10-year yield. But the historic average of this difference, of this spread, is 1.7%. So that's an over 1% basically difference because of the volatility and risk in the real estate market right now for housing mortgages. So that is why they're charging a premium on these. And I've got some great expert insights as to more reasons why this is the way that it is. Odetta Kushi, the deputy chief economist for First America, says the spread is not always consistent. It actually widens during periods of economic and geopolitical uncertainty, as has been the case in today's market. Well, you're exactly right. Economic and geopolitical uncertainty. Check out the news station any given morning or night, and you're going to certainly see the geopolitical uncertainty in the world, but also our local United States economy and the uncertainty with inflation and the pressure with interest rates as well. That has played a big role into the spread of this spread growing wider. Mark Fleming, chief economist from First America, says a primary driver of the increase in the yield over 2023 was inflation expectations. So the higher the current rate of inflation, and more importantly, the higher the expected future rates of inflation, the higher the yield on the 10-year will be. So basically, inflation has really been the key indicator driving the increase in interest rates. If inflation looks like it's under control, if inflation gets close to that 2% marker that the government is looking for, then we'll expect to see easing in interest rates. But if inflation stays high, we will expect to see the pressure on interest rates continue to stay high from the government as well. So really, that is going to be the key thing that we're monitoring and looking at, is not just mortgage rates, but inflation. If we get positive inflation news, we're going to feel positive about where mortgage rates are going. If we get negative inflation news, I'm going to feel negative about what might happen with mortgage rates in the near future. He continues, there is reason to believe that the rate lock-in effect will ease modestly this year as mortgage rates begin to come down. And you could only imagine if they get below 6, then even more people would again be in the money, and homeowners will become less anchored to their low mortgage rates and begin to get in the market. So what Mark's saying here is those homeowners that have a 3%, a 4% interest rate, they feel locked to their home because their rate is so advantageous. Well, if rates get down below 6, the projections are that home sellers are going to start coming back out of the woods. They're going to get their homes listed. They're going to find their next home because affordability is going to improve for them, which will be a good news and good sign for the rest of the market, because that means more of those homes will be coming to the market. More inventory will be coming to the market, and that is positive news. Dean Baker says it also appears that mortgage rates rates are now falling again, they will almost certainly not fall to the pandemic lows, although we may soon see rates under 6%, which would be low by pre-Great Recession standards. And Doug Duncan with Fannie Mae says, we anticipate that after the past several years of extreme volatility in interest rates, the 30-year fixed rate mortgage rate will continue to moderate over the course of 2024, moving toward a rate below 6% by the end of the year. So that is 3 quotes in a row talking about interest rates getting below 6% by the end of 2024. And that is phenomenal projections. It makes me feel warm and fuzzy. Personally, I don't know if I want rates to fall that drastically this year, because ultimately I don't want to see us ever to have to reverse course and then start raising rates again. I don't want to see inflation coming back to the market in such a short window of time. I want to make sure inflation stays at bay, stays at a reasonable level, and that interest rates can kind of moderate and slowly come down and help homeowners and home buyers with affordability when it comes to buying a house. But let's look more at those current and now future projections of mortgage rates. These are projections from Fannie Mae, and they updated their projections from 2023 to January. They updated these projections. So previously they projected 7% interest rates for Q1. Now they're saying 6.4, 6.8 in Q2, but now they updated that to 6.2, 6.6 in Q3, but that projection is now updated to 6, and then 6.5 in Q4, but now they're projecting Q4 to be 5.8. That is another number below 6. So that is now 4 in a row expecting interest rates to fall below 6. I hope it happens. I think it would be a really strong boost to the housing market. It would bring a strong influx of affordability to buyers, but I also want to make sure that this inflation problem stays behind us and doesn't rear its ugly head in the near future if we do go this route. So there you have it, guys. That's your February housing market update. How do you feel about the housing market? What housing questions do you have? I want to make sure I'm answering the most pertinent questions and details about housing that pertain to you. So make sure you reach out, send me a comment, shoot me a message about what you want to hear more about, and I'll make sure my next video addresses just that topic. Thanks for hanging with me today. Make sure you keep it real estate out there, guys.